India, since the private equity industry has evolved, we have some of the most prominent recently closed funds in the Indian market, as well as LPs who are being long-term investors, very long-term investors in India, and continue to be active. So hopefully, we'll be able to touch on a lot of points that are relevant. So quickly getting into it, I think the important part, the relevance of our topic, in terms of terms, GPLP terms, I think is very important. It's an important tool as it sort of helps align, interest between the LPs and GPs, and that's critical because this is, a long-term marriage, and it gives a structure in terms of how to manage that and keep everybody motivated over a long time. So, just to kick it off, I want to ask, my panelists here, just to touch on, how these terms, GPLP terms and partnership terms have evolved, over the last many cycles. Part of my thing, I'm looking at you since, just to give you attention, I know you're coming a little bit. but you've been very active in this market. What is your perspective in terms of how these terms have evolved and what remains relevant today as you see it in terms of funds today versus 7 or 8 years ago?
The two ways of answering that question is to look at what the trend has been and also the Indian market in terms of the fund sizes. You could put them into greater than $1 billion or even lesser. And in India, even within the $1 billion, you have at the upper end and the lower end. The big picture is that there have not been any positive trends in GP terms in India, but there have been positive trends of GP terms in other markets, in the US and the Europe, and we can go into that, but the big picture is yes outside and no inside. I'd be happy to delve into that a bit more as we go along.
Yeah, great. Let me bring in the other perspective here, and actually maybe I'll turn to you. You've raised funds, starting 98, 99, raised 6 funds since then. So, you've seen good times, by which I mean you went to more tailwinds in the industry, to more challenging times where Indian private equity is, much tougher to sell. From your perspective, what have those learnings been in terms of, terms, and how important is it, how challenging has the aspect of terms been in terms of convincing LPs and what their demands have been over time?
Yeah. So I think, as everyone knows, ultimately it's economics that determines it, the economics of demand and supply. Which is there are more people looking to invest in India versus people looking to raise capital, then people who are raising capital have that economic leverage or negotiation leverage, and we see that on both sides, right? Both when we raise capital as GPs or when we make investments in companies, it's a question of number of people who's chasing home. So I think we've had the fortune of raising 6 funds over these last 13, 14 years, and we've seen times in '99 where it was great times, and you had the .com bust, and then you had 2004 to 2007, which I would say the golden period in private equity, and then thereafter post-Lehman we've seen that. I think broadly, what our experience has been is you have the ability to gain leverage in good times, but what we learned early on is, we rather have things a little more fair and spread that over time. And I think you get brownie points from LPs over a period of time. So I think if you ask most of our LPs, they'll say, even though we may have raised funds, for example, in 2007, our funds were 4 times oversubscribed, right? But if you ask any of the LPs in that terms, I think generally most people would say they are not too bad. I don't think we squeezed anyone. That was the question. I think you see that and you get the benefit of that in future funds. And I think we've definitely experienced that when people talk to you about critical things that really hit them and they understand where your perspective as to some things which you may be a little more sensitive about. So there's a lot of give and take, which I think helps you over a long period of time, and we appreciate our LPs thinking like us, in that perspective, and being fair. I think being fair is to be on both sides of the table. You can't. I don't think an LP should screw a GP or a GP should screw an LP in good times, but I think you have to be moderate in both situations, and I think that's the key in my mind from a longevity perspective.
Right. I think so. Essentially, you're saying fairness is important, keeping it consistent, and I think that's a great problem to have, right? I mean, because the terms usually come in later. So your LPs are sort of signed off on the product and the theme of the strategy. But let me bring in another LP's perspective from Jagannath here. Very often we see a lot of funds don't have that fortunate position where fundraising is more challenging. They're struggling to get to hard caps, get to targets to get hard caps. 4 times oversubscribed to create a place to be, a problem to have. Jagannath, from your perspective, curious to are you seeing terms, or let me put it differently, right? For funds that have struggled a little bit more in terms of fundraising, do you see more opportunity to ask for terms? Is that something LPs are focusing on, or it's are you generally happy with terms the way you are seeing? Is there something more on your wish list, both from funds that are getting to the hard caps as well as some of the funds that are facing more headwinds?
And I think there are kind of multiple layers to that, right? So let's take a situation where let's say there's a fund which has had a little bit of a long. So let's assume that all the prerequisites which an LP would look for, which is kind of longevity of track record, etc., exists for that fund, and maybe let's assume that just given market conditions, it's a bit difficult, for the fund to kind of get to where it had been planned for. So I think in that situation, certainly we are seeing quote-unquote incentives provided by biggest GPs, be it either a step down in fees for first close investors, sometimes even kind of goes beyond first close. In some situations, we've seen co-investment rights being offered as well. Fee offset, how between anywhere between 60% to 100% kind of fee offset. There could be a bit of a sliding scale, which is kind of offered to various LPs who kind of come in at different kind of closes. So I think that's one sort of situation. The second sort of situation is where some of the prerequisites for the fund are just not there, and there is natural lack of appetite from an LP perspective for the GP. I think those tend to be difficult situations, irrespective of whatever incentives they might kind of offer. So I'm not necessarily sure that that is primarily driven by what we're seeing from an incentive basis. I think the third angle to this is, and this kind of goes back to kind of Param's point. I don't necessarily believe that incentives or LP-related incentives, whether they are whatever you want to call it, fair practices or kind of market practices, necessarily have to exist in a fund which is struggling to kind of raise capital. Yes, there is always the balance of power type kind of question at play, who has the power in this particular situation. But I also believe that GPs, at least in a few markets that I've seen in Southeast Asia, are starting to, so good funds which have had the longevity of track record, have phenomenal LP appetite, are saying, look, market conditions have changed and we need to give LPs the benefit of that. So given that they are investing in riskier markets as Southeast Asia, we're going to change our fee structure. So where it might have been a flat 2%, we're actually seeing a step down on invested capital post the end of the investment period as well. So I think there are GPs, at least in other markets in Asia, who are starting to realize that the underlying risk characteristics of the market has kind of fundamentally changed. And some of that is then flowing back as incentives to continue LP capital flowing into those kind of markets. I'm not seeing that happen in India. I think it would be great to see that happen in India. And that's I think goes back to Param's point around saying the trend has not been positive, at least from an LP perspective.
Right. Param, do you want to add something here before we move on a little bit?
No, it's good. Yeah.
Okay. Jagannath, thanks for that perspective, and we'll come back to that. I want to touch on that again. But I want to just sort of, bring Rahul into the conversation here, and you know, would love to get your perspective on, you know, because in a way, you know, we have this, you know, a Western style PE model that we've been working under for a long time. It really hasn't been reinvented too much, right? I think there's some important levers between management fee and carry and hurdle, and I think there's those are important too. But I mean, is there something different, Rahul, from your perspective that you see that, you know, terms need to change, or to make this, you know, just to sort of re-energize the system a little bit, or do you think this is the best model that India has for PE long term?
Answer that question in two ways. I think that if you ask me whether the business model that exists for private equity in India, whether that's perfectly apposite and appropriate to the Indian ecosystem or for emerging markets, I don't think so. I think it needs a rethink, and it needs, the whole construct needs to change. And that's got more to do with the whole business model in how the end investors' goals are best met, and most efficiently in terms of cost, rather than the current system which exists, which was designed for a totally different environment and ecosystem. It was designed for an American ecosystem. It was designed as a financial engineering leverage product. And a lot of the terms and the constructs of the arrangements are actually built for that. It's not designed for maximizing LPs' returns in a growth-oriented market and returns which should come out of growth. But having said that, I have a more fundamental issues with how most of these terms work. Very fundamentally, and you know, that's the way I look at it at least. LPs are making a call to entrust money across oceans to a bunch of people who pretty much have complete sway as to how that money is invested. And if you look at the quantum of trust required, or that leap of faith which is being required to part with that capital for that tenor, actually, if you think about it, very little oversight. Then sometimes the amount of time which is spent on inane subjects in terms of LPGP arrangements just does not make any sense relative to the basic call that the LP is making. And I think that ultimately this is a fiduciary business, and I think that the LPs have got to make a call whether the person they're partnering with is going to be a good fiduciary or not. And the GPs, the onus is on the GP as to how to conduct himself as a good fiduciary. And like in most other agreements that I've seen, I have never had instance to actually go back to an agreement, a written agreement, and go back and fine-tune it. But when the actual negotiations happen, and if you see the size of a standard LPGP agreement, it's, you know, thick binders of that nature, right? And what I've also found is that every LP's lawyer wants to add value. So he will discuss that if there is rain in Spain in 2040, then how would you tackle this issue? It's completely inane, but you will have heaps of correspondence and these things about it. But it's human nature at some level. So I think a one-page LP-GP agreement is what's actually called for. This is the economics, this is what you're mandated to do, and you will be a good fiduciary, and if you're not a good fiduciary, I will take my money away and run. There doesn't need to be more complexity than that.
So you're saying in essence, more control to the GP, less governance, less restrictions, you know?
Not at all. I think the bar is actually higher for the GP. I'm saying, be clear as to what the economic arrangement is. Then leave it, you know, ultimately you're trusting all of your capital to a GP. Right? Then if you try and sort of put restrictions on A thing or B thing, I think that a lot of the terms and stuff which is discussed and elaborately laid out is very minor. It's a subset risk compared to the main risk that's being taken. So I think that an LP is probably better served to spend 99% more time on making that fundamental call and less time on these nuances in terms of the agreements.
You know, let me bring in the other, perspective here, and Ashley, maybe I'll turn to you. You know, you've raised funds, you know, starting 98, 99, have raised 6 funds since then. So, you know, you've seen good times, by which I mean where there are more tailwinds in the industry, as well as more challenging times where where, Indian private equity is, been a much tougher sell. From your perspective, what have those learnings been in terms of, terms, and how important has it, how challenging has the aspect of terms been in terms of convincing LPs, and what their demands have been over time?
Yeah. So I think, as everyone knows, ultimately it's economics that determines it, the economics of demand and supply. Which is, if there are more people looking to invest in India versus people looking to raise capital, then people who are raising capital have that economic leverage or negotiation leverage, and we see that on both sides, right? Both when we raise capital as GPs or when we make investments in companies, it's a question of number of people who's chasing home. So I think we've had the fortune of raising 6 funds over these last 13, 14 years, and we've seen times in '99 where it was great times, and you had the dot-com bust, and then you had 2004 to 2007, which I would say the golden period in Indian private equity, and then thereafter post-Lehman, we've seen that. I think broadly, what our experience has been is you have the ability to gain leverage in good times, but what we learned early on is, we rather have things a little more fair and spread that over time. And I think you get brownie points from LPs over a period of time. So I think if you ask most of our LPs, they'll say, even though we may have raised funds, for example, in 2007, our funds were 4 times oversubscribed, right? But if you ask any of the LPs in that, the terms, I think generally most people would say they are not too bad. I don't think we squeezed anyone, if that was the question. I think you see that, and you get the benefit of that in future funds. And I think we've definitely experienced that where people talk to you about critical things that really hit them, and they understand your perspective as to some things which you may be a little more sensitive about. So there's a lot of give and take, which I think helps you over a long period of time, and we appreciate our LPs thinking like us, in that perspective, and being fair as well. I think being fair is to be both sides of the table. You can't, I don't think an LP should screw a GP or a GP should screw an LP in good times and bad. And I think you have to be moderate in both situations. And I think that's the key in my mind from a longevity perspective.
Right. So, I think essentially, you're saying fairness is important, keeping it consistent, and I think that's a great problem to have, right? I mean, because the terms usually come in later, so your LPs have sort of signed off on the product and the team, on the strategy, but let me bring in another LP's perspective from Jagannath here. Very often we see a lot of funds don't have that fortunate position where fundraising is more challenging, and they're struggling to get to hard caps, get to targets, forget hard caps. 4 times oversubscribed, great place to be, a problem to have. Jagannath, from your perspective, curious, are you seeing terms, or let me put it differently, right? For funds that have struggled a little bit more in terms of fundraising, do you see more opportunity to ask for terms? Is that something LPs are focusing on, or it's are you generally happy with terms the way you are seeing it, or is there something more on your wish list, both from funds that are getting to their hard caps as well as some of the funds that are facing more headwinds?
Yeah, I think there are kind of multiple layers to that, right? So let's take a situation where let's say there's a fund which has had a little bit of a long. So let's assume that all the prerequisites which an LP would look for, which is kind of longevity of track record, etc., exists for that fund, and maybe let's assume that just given market conditions, it's a bit difficult, for the fund to kind of get to where it had kind of planned for. So I think in that situation, certainly we are seeing quote-unquote incentives being provided by various GPs, be it either a step down in fees for first close investors, sometimes even kind of goes beyond first close. In some situations, we've seen co-investment rights being offered as well. Fee offset, how, between anywhere between 60% to 100% kind of fee offset, there could be a bit of a sliding scale which is kind of offered to various LPs who kind of come in at different kind of closes. So I think that's one sort of situation. The second sort of situation is where some of the prerequisites for the fund are just not there, and there is natural lack of appetite from an LP perspective for the GP. I think those tend to be difficult situations, irrespective of whatever incentives they might kind of offer. So I'm not necessarily sure that that is primarily driven by what we are seeing from an incentive basis. I think the third angle to this is, and this kind of goes back to kind of Param's point. I don't necessarily believe that incentives or LP-linked incentives, whether they are whatever you want to call fair practices or kind of market practices, necessarily have to exist in a fund which is struggling to kind of raise capital. Yes, there is always the balance of power type kind of question at play, who has the power in this particular situation. But I also believe that GPs, at least in a few markets that I've seen in Southeast Asia, are starting to, so good funds which have had the longevity of track record, have phenomenal LP appetite, are saying, look, market conditions have changed and we need to give LPs the benefit of that. So given that they are investing in riskier markets as Southeast Asia, we're going to change our fee structure. Right? So where it might have been a flat 2%, we are actually seeing a step down on invested capital post the end of the investment period as well. So I think there are GPs, at least in other markets in Asia, who are starting to realize that the underlying risk characteristics of the market has kind of fundamentally changed. And some of that is then flowing back as incentives to continue LP capital flowing into those kind of markets. I have not seen that happen in India. I think it would be great to see that happen in India. And that's I think goes back to Param's point around saying, the trend has not been positive, at least from an LP perspective.
Right. Param, do you want to add something here before we move on a little bit?
No, it's
okay.
Good. Yeah.
Okay. Jagannath, thanks for that perspective, and we'll come back to that. I want to touch on that again. But I want to just sort of, bring Rahul into the conversation here, and would love to get your perspective on, what, because in a way, we have this, a Western-style PE model that we've been working under for a long time, and it really hasn't been reinvented too much, right? I think there's some important levers between management fee and carry and hurdle, and I think there's those are important tools. But I mean, is there something different, Rahul, from your perspective that you see that terms need to change, or to make this, just to sort of re-energize the system a little bit, or do you think this is the best model that India has for PE long term?
Answer that question in two ways. I think that if you ask me whether the business model that exists for private equity in India, whether that's perfectly apposite and appropriate to the Indian ecosystem or for emerging markets, I don't think so. I think it needs a rethink and needs, but the whole construct needs to change. And that's got more to do with the whole business model and how the end investors' goals are best met and most efficiently in terms of cost, rather than the current system which exists, which was designed for a totally different environment and ecosystem. It was designed for an American ecosystem. It was designed as a financial engineering leverage product. And a lot of the terms and the constructs of the arrangements are actually built for that. It's not designed for maximizing LPs' returns in a growth-oriented market and returns which come out of growth. But having said that, I have a more fundamental issues with how most of these terms work. Very fundamentally, and that's the way I look at it at least, LPs are making a call to entrust money across oceans to a bunch of people who pretty much have complete sway as to how that money is invested. And if you look at the quantum of trust required, or that leap of faith which is being required to part with that capital for that tenor, with actually, if you think about it, very little oversight, then sometimes the amount of time which is spent on inane subjects in terms of LP-GP arrangements just does not make any sense relative to the basic call that the LP is making. And I think that ultimately this is a fiduciary business, and I think that the LPs have got to make a call whether the person they're partnering with is going to be a good fiduciary or not. And the GPs, the onus is on the GP as to how to conduct himself as a good fiduciary.
And like in most other agreements that I've seen, I have never had instance to actually go back to an agreement, a written agreement, and go back and fine tune it. But when the actual negotiations happen, and if you see the size of a standard LPGP agreement, I mean, it's, you know, thick binders of that nature, right? And what I've also found is that every LP's lawyer wants to add value. So he will discuss that if there is rain in Spain in 2040, then how would you tackle this issue, which is completely inane, but you will have heaps of correspondence and these things about it. But it's human nature at some level. So I think a one-page LPGP agreement is what's actually called for. This is the economics. This is what you're mandated to do, and you will be a good fiduciary, and if you're not a good fiduciary, I will take my money away and run. I mean, there doesn't need to be more complexity than that.
So you're saying in essence, more control to the GP, less governance, less restrictions, you know, you need to...
Not at all. I think the bar is actually higher for the GP. I'm saying be clear as to what the economic arrangement is. And then leave it, you know, ultimately you're trusting all of your capital to a GP, right? Then if you try and sort of put restrictions on A thing or B thing, I think that a lot of the terms and stuff which is discussed and elaborately laid out is very minor. It's a subset risk compared to the main risk that's being taken. So I think that an LP is probably better served to spend 99% more time on making that fundamental call and less time on these nuances in terms of the agreements.
Right. You know, one of those topics, and I'm not sure where you stand, but I'm going to open this up, is one which we hear a lot in the Indian context, which is, you know, we always, in these terms, we always have a lot of restrictions, be it in terms of sector concentrations and in terms of, you know, what is off strategy and how much you can do and so forth. And you know, there's a school of thought, you know, that, you know, GP knows his market best, GP's on the ground, you know, he needs to be able to be nimble to leverage the best opportunity as they present themselves. LPs sometimes have different takes on it, and I think that's where these concentration limits come about. And one that we've seen debated a fair amount, you know, me being on the LP side, is you know, on pipe transactions, for example, right? You know, different markets have different attributes, and India has certainly been one where, you know, private equity firms have done well doing public investing. LPs, you know, may think that's not what they're paying higher returns for versus a mutual fund or even a hedge fund. So, you know, would love to get perspectives here. I don't know, Param, is there anything, you know, from your standpoint you want to add? I'd love to get Ashley and as well as Paddy on it later.
You invest on a premise, and over 5 years of investment and over the life of the fund, you hope the fund manager delivers, and the onus is on the GP. So that's clear. And that premise is different for different investors. For us, we prefer not to pay the 220 on stock picking, even though they might be value, but we think there's enough opportunities out there where you can go in and make money on private stocks. That's the way we look at it. We appreciate the flexibility that people put in with the caveat that's defined by a certain percentage number, and that's fine with us.
Right.
I think what's probably more important than the legalities around it is that I think the onus is on the LP and the GP to feel comfortable that the process that the GP has in place, the talent, the process, the risk management, the alignment is suitable for the strategy that he's undertaking. And if that changes, then I think the question that needs to be asked is, are these elements still there to pursue what's required, and or is it just an opportunistic reaction? I think they're two different things. If you're prepared for a particular possibility in the marketplace, I think that flexibility should be inbuilt. If you're reacting to something, I think it's usually dangerous to permit that kind of flexibility.
Right.
If I can just add something on the pipe question. I think a common mistake which a lot of kind of global investors just outside in kind of looking at India make, especially from a pipe perspective, is that I don't think they understand the nature of pipes in India. And there are two layers to this. One obviously is, just purely, let's say, liquid, stock. You're just taking a 2 or 3% kind of stake in a fairly liquid stock. That is stock picking. I think that's certainly left best to hedge funds. Certainly, I don't see why an LP should pay 2 and 20 for that. But I think a majority of pipes, at least the way it's done in India, is fundamentally different. Most of these stocks are illiquid. Promoters still own 70-75% of the business. When you are essentially investing into a publicly listed company, the negotiations are actually happening with the promoter happens very similar to a private transaction. So I think that is extremely PE-like. So that's very private-like. So I think in that situation, I don't think that is unlike investing into a quote-unquote pure private equity fund. So I think it's not about pipes, but I think it's about the type of transactions that you do under that broad bucket. As long as you are doing it under PE-like characteristics, I don't think it makes any difference.
Okay, got it. Yeah, Paddy, is there anything you wanted to add?
Yes, on the pipes bit, I would go back to defining a strategy up front, and then within certain boundaries, as long as you're sticking to the defined strategy, it's fine. And then obviously the costs are known up front, linked to that strategy. So in our case, for instance, we have a fair amount of flexibility in doing pipes, but in practice we're going to be discerning and selective and conscious of the fact that there is a particular strategy we sold to our investors. So that's how we look at it. But our LPs have been quite fair and balanced in their approach, and they've not put undue limits on us with respect to pipes.
Yeah, I think we had something similar as well, where I think it took a little bit of explaining in the early years to explain why pipes in India are relevant in the private equity construct and why it forms part of the private equity product. And that's fundamentally, the way we look at an investment. I think in India, as Jagannath said, I think it's not a question of liquidity, right? It's in our mind, if a company is listed and you're doing a transaction, and that only the form of your investing and exiting may be different, but your role over that 4, 5, 6 year period of investment typically would remain similar regardless of whether the company is listed or not. And that's what we have seen and we have done over a period of time. And then once you get comfortable with that concept, that is private equity, then I think, it should not matter, right? It's a subset. It's a strategy that you may have. You may have flexibility to do X% or Y% within that. But it's as good as saying, I want to look at certain sectors, I want to restrict certain sectors. Once LPs make that fundamental call that they are comfortable with that particular strategy, and they accept it that this is a private equity product, then the economics, terms, etc. should be similar regardless of those niches or sort of nitty-gritties in the strategy.
Right. Rahul, is there anything you were looking to add, or?
I'll go back to the being a good fiduciary question. Often you'll find situations in India where, and if you take the last 5 years data, take the population data, and I'm not talking about sampling, I'm talking population data of every private equity deal done, right? Whether it's in the private space or in the pipes space. And you compare it with the listed markets. In IT, you will find that every deal done in the last 5 years, and I'm not talking of the venture space, but the private equity space, you'll find every single deal done is at a premium of over 30% to the EV/EBITDA multiples in the public markets. So much so in IT's case, it is at a premium. It is at a over a 20% premium to the big 4 IT companies in India, which have superior franchises, customer base, more higher earning momentum, the whole lot, right? I think, Ashley and his team have invested, for example, in HCL, which is one of the bigger companies. It made so much more sense to do that. It was so much more logical. Take the same data in pharmaceuticals. You will find the same thing. Now, the real issue is that as somebody who is managing money in trust, and ultimately this is a fiduciary business, is it the responsibility of that GP to say, no, I should stick to doing, this is called notionally private equity, so I will take higher risk, take more liquidity risk, more scaling risk, more governance risk, be locked into something for a lower return than something which is more favorable in terms of risk-return construct to my investors. And I think that's a very fundamental question, and this would not arise in the developed markets because the markets are far too efficient. But in markets like India, you get these bubbles, and these bubbles last not for 6 months and 12 months, often for 4 years and 5 years. Right? So I think one needs to step back and say that either should I be investing in this asset class at all, or should I be entrusting my manager to make this call for me? And allow him that flexibility, maybe review it from time to time as to why he's doing it and understand the logic. But I do believe that that's necessary for people to undertake just their pure fiduciary role.
Right. So I think, the way I see it, having been looking at this for 10 years, I think it's evolved. I think there were more people on the other side of the fence 10 years ago saying why because most of the decision makers were sitting in US or Europe as providers of capital, couldn't understand why PE funds were doing pipe deals. And I think hearing everybody here, I think there's a greater acceptance of that, as Jagannath said, as long as it's well communicated and there's a reason for private equity to do that. And I think which is essentially a lot of the panelists have said now. I want to shift gears a little bit, and Paddy, I want to bring you in on this since you guys had a fantastic fundraise, just last year. From having been on the road, raising that capital, from what you saw, what do you think was seemed to be some of the key hot button, top of mind issues for LPs? I mean, if you're a good fund, LPs don't care about terms, or are LPs still, you've sort of found trying to, get more favorable terms, be it through incentives of committing capital early or asking for additional rights to commit large checks, be it co-investments. So, I mean, what are the dynamics on that front even for a successful fundraise, or to make a fundraise more appealing to LPs?
So in the first instance, the terms are not obviously the initial gating factors. The gating factors are more around the strategy, the team, in our case, sponsored fund, first-time fund. These were the first set of real filters in deciding whether to pursue the investment or not. So I don't think terms were ever a deal breaker for us. The second important element is that if you are reasonable to begin with, for instance, to just pick up a couple of examples, we had a no-fault divorce clause. We were absorbing all transaction costs. No transaction costs get billed to the fund. And of course, for early investors and large investors, you offer them fee rebates. So if these are reasonably built in, key man clauses, if all these are reasonably built in, again, apart from the lawyers' discussions, I don't think we had a huge deal of commercial discussions on terms. So I think the decision making for LPs was firstly around India itself, and in our base of LPs, they had relatively less experiences in India, which I think a lot of LPs who got a lot of capital in India and are looking to get returns on those were probably less forthcoming on making significant India investments. And then around the strategy and the team, and then we had some discussions obviously on some of the points, but as I mentioned to you, Arjun, we were sort of preemptive in some key issues, and that really helped, because then the other side also commercially believes that you're being reasonable, and there's no point in splitting hair over too many of these items.
Got it. So what you're saying, obviously the first point is getting comfortable with the strategy, terms come later, and then being sort of fair and reasonable, in an approach. I want to shift, I don't know if anybody would like to add anything to this question here. I want to change this, look at it from a different standpoint perhaps, and bring in maybe a sort of a more broader Asia perspective, a global perspective, and I'm going to ask our LPs on the panel here. Is there anything you guys see, from your wish list, right? The way I see the world is GP capital is always fungible, right? It's always going to go, for the most part, to the best use it can be put to, right? The LPs, there'll be certain LPs who have a pre-allocated bucket, come what may, they'll commit to a certain strategy or a certain market. But what we've seen in reality is, especially in the last couple of years, I think global PE commitments have been going up, but Asia and emerging market shares come down a little bit, and I think within that bucket, India has lost to other emerging markets a little bit, right? So is there from an LP's perspective, as you guys look at it, I mean, is there anything from a terms perspective that, would re-energize the LPs to sort of re-look at India, or is it more sort of outside the realm of terms? Is it just strategy and the attractiveness of the market, or is there something LPs want to see on terms that would get them sort of more excited about committing capital?
What you see in other markets is, money speaks. So if I like a GP, and GPs are great if they put in their own capital to work. So outside of India, if you're talking about Europe and the US, people put in at least more than, the trend is going up, so they put in more than 3% of the committed, target fund sizes, committed capital up front, and that number has only been increasing. In Asia, you find a lot of that in China, where they put in absolute dollars, and that's very comforting to an LP. The second point is whether you want to talk about hurdle rates and what makes sense in India, what does not. You could argue both ways, and as an LP, I would argue for an LP. So whether you want, irrespective of the cost of capital, I'm still looking for higher returns. So I don't, so for me, I'd like to see more GP commitment. In an Indian scenario, you have many reasons why that might not be possible. But that for me is very comforting.
Jagannath, anything?
Just to add to that, Harbourvest as an organization, we've been looking at, we've been investing in Asia pretty much since the late 80s. So I think we've had the advantage of seeing a lot of these markets pretty much evolve over the last kind of 20 years. And I think especially over the last, kind of half a decade, I think in markets similar to India, especially in markets like Southeast Asia, we've seen a pretty, not necessarily a drastic, but certainly a stronger evolution in terms of terms, even from successful GPs. And I think a few things which have certainly moved. One, I think on management fees, we are seeing a step down even post-commitment period. So, traditionally, obviously, you had the 2%, fees, which was flat. Only the base on it would change post-investment period. But, even post-investment period, we are seeing actually GPs now saying we'll only take 1.25 or 1.5% on invested capital post the commitment period kind of coming through. It's just, I think the thesis around that is, look, once the investments have kind of done, just managing it is going to take, lesser quote-unquote resources to be able to manage that. Two, I think just purely in terms of some incentives coming in for first closes, kind of investors, especially investors who are willing to take a bet much earlier in the fund cycle. I think we are seeing discounts there as well. Third, I think we're seeing certainly GP commitment numbers moving up. And I think the thesis is, GPs are putting their money where their mouth is to some extent. I think the degree to which GPs are doing that, certainly in other markets, is kind of going up. Last, I think, is the whole, kind of hurdle rate argument. I think in markets where, it's more kind of dollar denominated and the broader economics of the businesses are more kind of dollar oriented, I think the 8% hurdle rate still kind of makes sense. I'm not necessarily sure that, an 8% hurdle rate from a risk adjusted basis for India is still the right number. Because if you're getting an 8% hurdle rate on a US fund, I don't see why the number should not be higher for an India fund, because fundamentally I think the risk is different. I think in a few markets and in a few certainly GPs which are coming to market now, we are seeing that number move up, and that might be the right thing for India, I'm not sure. But I think at least broadly, from a market perspective, we are seeing an evolution across board.
Yeah, I mean, I think one thing we certainly saw on a global basis, right? I think, post-GFC, the LPs really took an advantage of an opportunity they had. Fundraising was very hard, and GPs really took the opportunity and pushed the ILPA guidelines, right? I think for the prior 7 years, the GPs clearly had the better end of the stick. It was a fantastic fundraising environment. Fund sizes kept getting bigger. management fee rates didn't drop. Even funds had gone 4, 5, 6 times their size from 5 years ago, and funds touching 10 billion and more and still charging crazy fees, and new GPs were getting rich, but LPs took the advantage and pushed the ILPA guidelines, which has sort of set a new construct. So I think in the Western world we've seen, as some of the LPs were saying, we've seen management fees come down. We've seen a little bit of a better alignment of interest. And I don't know if that's enough for LPs to get excited about those markets, but clearly in the last 5 years, more capital have gone as a percentage basis to some of the developed markets, and a lot of it is maybe to do with quantitative easing, low interest rates, so on and so forth. But that's, the question is, what's next? How do we get capital back in India, and its terms, will it ever have a role to play? We didn't touch on one thing which I know globally is very important to our many LPs, especially large LPs, right? The guys who are going to move the needle on our fundraising, which has often been co-investment, right? Large LPs want to put big, dollars to work. Is that something, is that a trend? I want to, ask Ashley, you guys closed a fund, not very long ago, and you clearly have a great list of LPs. Is that something you see a request for a lot?
No, certainly I think we've heard and received a lot of requests around co-investments. I think, again, India is a little bit of a challenging environment from that perspective, right? I mean, in terms of, if I were to look at private equity investors, GPs investing in India, touching on something Rahul said earlier, there's a lot more capital chasing Indian companies today, right? And that's partially the reason why private equity valuations are much higher than public valuations in general. So you have a situation where already most every deal that we look at is intermediated. There are 3 or 4 guys, and there's a lot more leverage on the other side. The amount of capital that most people want to invest in companies is already being squeezed down. So then realistically, our question to LPs is, look, we understand you want to do co-investments alongside us, but and a lot of times we are fighting to get a deal big enough for ourselves. So there's not much to sort of go around the table. So that is something I think we have to live with. I think we understand that there are people with deeper pockets who can move fast, and I think if I would look at a number of co-investment deals that have happened, they would be probably under 2-3%, right? Where people have gotten their LPs to come in and participate. And I'm sure the LP panelists here can give you a better picture of what they've done. But typically we've seen people want co-investments, but practically I don't see much of that happening in the Indian market until there is some level of consolidation at the GP level itself, and it comes to more reasonable size in terms of number of GPs, amount of capital to be deployed versus amount of capital being raised. So until you solve that problem, you can have a co-investment right or a co-investment option. I don't think anyone will give it to you as a commitment. But if it's an option, we've not had to exercise that option, in 60 odd investments that we made. So if that gives you some sense of the market.
Yeah, I think in certain markets you're seeing more of that, especially with the sovereigns of the world who are consolidating their positions and are picking their horses, so to speak, and committing more capital behind them. I mean, Paddy, is that something? You guys have some very large sovereign kind of LPs in your fund. Is that a dynamic you've seen in your fundraise?
I think some of the larger investors are looking for co-investment opportunities. And going back to the fee discussion we had earlier, co-investments also help bring down the overall fee in their minds. So I think that for larger deals, we do plan to bring in our LPs as co-investors. One of the other challenges there in that context is that the LPs may not be staffed or resourced to move quickly on an India deal. So sometimes you need them to do that. So it needs to match in terms of timing, appetite, and all those factors. But directionally, I think there is strong interest in co-investment, and we've been talking to our LPs in quite a few of this.
Right. Rahul,
I think co-investment opportunities come up typically when one is trying to optimize portfolio construct. So sometimes you like a deal, it makes a lot of sense, but your sector exposure in your fund has gotten too high, or that one particular deal is way too high compared to other deals that you have, and it will distort the overall risk balance of your portfolio. Often I think opportunities come up because of those reasons rather than the actual size of the transaction. And what we have found is that there are two kinds of LPs. All LPs say we want co-investments. There are some who are equipped to do them and some who are not. And the ones who are equipped to do them have a huge disproportionate advantage because their turnaround time, speed are completely different.
Right. I think looks like we're running out of, or we have run out of time. Any questions from the audience for the panel here? Okay. Okay, I think that's it then. Guys, thank you very much for, great perspective and thoughts on the topic. Thank you all.